So you just saw how care is really embodied in how we think about the platform. And it's really not just because we think it's the right thing to do, although of course we do, but it's because we really believe that this is critical to building a sustainable business. And so, we wanted to follow these sessions about care with the session about our financial performance. So for the final session today, I wanted to introduce our CFO, Mark Dimitrek, and then virtually our CAO, Chief Accounting Officer, Marie Fallon, who couldn't be with us in person today, and talk about, how this business model has matured and evolved, and answer some of the questions that I know you and I get a lot from investors, and try to shed a little bit more light on those topics. So thanks for joining us, Mark. Can you share a little bit about your background?
Yeah, sure. Happy to do that. So I joined Gingko as the new CFO about 6 months ago. And I've spent about the past 20 years in the life science space. I spent 10 years with Thermo Fisher Scientific, and then the past almost 10 years with Syneos Health, the global CRO, contract research organization serving the biopharma industry. And then prior to all of that, I had a career with Ernst & Young.
Great. And then Marie, who's joining us virtually, could you introduce yourself quickly for everybody?
Absolutely. I'm sorry I couldn't be there with you in person. Marie Fallon, I work here at Gingko. I'm the Chief Accounting Officer. Prior to this, I have been at big institutional companies in controllership roles, a variety of different roles focused on accounting, reporting, internal controls. Prior to that, I was with Ernst & Young for 10 years as a senior auditor.
Great. Well, I know I, for one, am very glad that you joined us, and you've been a great asset to the team. So I thought, sort of selfishly, I get asked a lot of questions by investors, and thought we could use this time to help bring a little bit of color to those. And to set the stage, we obviously have these kind of two core elements of our business model. The first being, the foundry revenue, which is just as customers pay us to use the platform on sort of a usage basis. But then we have this downstream value component, and part of that is, sort of a more traditional milestone and royalty model, which you can ascribe a value to through some projection modeling. But then we also have this equity component for some of our transactions, which we'll accept in lieu of a royalty, particularly with earlier stage companies. And the interesting thing about those is, we can look at the historical data that we have on how third-party investors have put a value on that, and that really does help us, think about the kind of cumulative value of these programs on a combined basis. And so one of the questions that I get sort of on this point is how do we think about the margin profile of the business given the kind of difference in timing in these different elements of the model?
So the first thing that you have to recognize is that the numbers you're looking at, both historically and in our projection period, are only the foundry revenue line. And so all of that downstream value share that we've been talking about, and as you know, that'll contribute ultimately at a 100% contribution margin when it flows through. None of that is
because we're done doing the work at that point.
Exactly. Yeah. And so none of that is in the numbers and therefore in the margins that you're looking at. But just to talk about the foundry revenue line, so you can see that we are projecting that by 2024 we'll be approaching break even on the EBITDA line. I would expect that it would mature into a 20 to 30% EBITDA business line.
And I'm sorry, why 20 to 30%?
Yeah, so it's a very typical margin profile of a life science tools company or a pharma services company, and I've worked in those two industries for the past 20 years. And so that's the foundry revenue line. And then the question really becomes, okay, how do you then think about the downstream value contribution? And so the way we think about it internally is we do factor that downstream value share in when we think about the pro forma sort of economics and margin of a particular program. So when we sign a new customer on for a new program, and just to take like an illustrative example, let's just say that we've got a program that is going to cost us $4 million of work to deliver over the next, call it 2 years. And so our fully burdened cost, $4 million, we would charge the client $5 million of foundry revenue, foundry usage revenue for that.
And that's the 20% margin, EBITDA margin for that
yes.
Foundry business you were talking about.
In the sort of mature state for Gingko, we would have a 20% EBITDA margin, and that's exactly the 5 million less the 4. And so that's your foundry revenue. And then on top of that, we would negotiate a downstream value share. And today, based on the data that we have, we are seeing that the downstream value share is worth about a $15 million net present value per program.
And what does net present value mean? How do we get those numbers? What do they represent?
So the 15 million net present value is a risk-adjusted NPV. And so we have looked at the probability of both technical success and commercial success. And so we are not saying that every program will be commercially successful, but once you risk adjust for that, the net present value for all programs is $15 million.
And how did we come up with the 15?
So that is based on actual experience of programs that are in flight to date and have been over the past couple of years. And it is sort of more specifically calculated with reference to those programs where we have an equity interest. And so the advantage with those is that they are marked to fair market value by third-party investors. So we do have a reference point. We can look at what investors are valuing a particular customer at. We know our percent ownership in that customer. And so we have a reference point to get to the 15 million NPV.
Yeah, and so in that way, it's really not even entirely academic, because there is, what you're saying is there's, real demand from investors for kind of these equity positions at a certain value, and that is how we came up with the $15 million number. And so, it sounds like we're making a choice, to own those equity positions or royalty streams rather than sort of monetizing them up front via the customer or their investors.
We could, in theory, just sell that equity investment today to one of the third-party investors at that valuation, and then we would be bringing that cash in today. So then to follow on that, so if you take that example where we have 5 million of revenue for the foundry revenue and then 15 million that we monetize today for the downstream value share, that would be a total cash inflow for that program of $20 million. And that's on a program that would cost us $4 million to deliver. So then when you look at that margin profile, you'll see it's about an 80% contribution margin. And that's how I think you would expect to see the Gingko margin profile trend up to over time.
And so that seems like a really high margin profile. Why does that feel right to you? What do we look at that makes that feel, sort of on a blended basis appropriate for the business?
Yeah, I mean, it's certainly higher than what you see in pharma services or life science tools, but more comparable to what you see in software or the biopharma industry, where intellectual property is a key component. And so that's the core. One of the core features of the Gingko business model is that we are bringing intellectual property via our code base and also our foundry capability to a client. And so we're able to negotiate those kinds of downstream value economics more comparable with those other industries.
Mm-hmm. So this whole conversation about, what is equity worth today and could we monetize it now versus later, it sort of reminds me of another question that I got asked a lot, which is when would we choose to eventually sell down an equity position that we might own? Why would we do it this year versus next year? Will we hold it forever? How do you think about that?
So I think the short answer, that's something that we will be evaluating over time. But the short answer is as long as Gingko is continuing to contribute value to that customer, we would look to hold on to our equity interest in that customer. And so we do expect to expand the number of programs with many of our clients. And so if the customer reaches a point where the work that we've done, the organisms that we have transferred over are fully in the market, and at that point in time, the equity value in what we've created is fully realized, then that would be at the point in time at which we would look to be downselling our position or exiting an equity position.
So with these multiple components of our business model, obviously there can be some complexity on how and when it shows up on the P&L. So I thought it'd be helpful for Marie to just walk us through some of the accounting. Marie, can you help investors understand sort of what they'll see over time as the model matures and as these downstream value elements start being realized?
Sure. So royalty and milestone-based revenues, those are the more traditional revenue streams that most of you are probably familiar with. The equity stakes, that is a little bit different. Gingko is a little bit different in that you may or may not see that equity on our balance sheet. That's because of the accounting rules and whether the nature of the company is a public company or a private company. But you certainly will see the value of that equity come through downstream when we sell the shares. That could come through as other income or revenue at that time. But because it is so unique, it's a little bit difficult to forecast. From a fulsome accounting perspective, it's difficult to see that in advance. But for that reason, we're going to continue to provide more information and more clarity throughout the course of this process to help you become more acclimated with it, since it is a bit unusual.
So how would an investor, if it's not going to show up on our balance sheet, how would investors be able to think about the value of programs where we might have an equity position? What can they look at?
So a couple things. First of all, you should look at our program counts, and that's a key metric we're going to be talking a lot about. How many programs, how many new programs have we signed up in this time period, this quarter, this year, and what's our cumulative program count? Because remember, even if we're done performing R&D services for a given program, we still have a right to either a royalty or an equity interest. And so the cumulative program count is an important metric. And then the 15 million net present value number that we've talked about, again, that's based on real data and historical data, but we will have more experience with that data point as well in time.
So with that, I think that was a really helpful overview of some of the questions that I get a lot, and I know you get a lot from investors. Maybe now we can just flip to a quick review of the historical financials. So I'll pass that to Marie to help walk us through that. Marie? So
in 2020, we increased total revenues to $77 million from $54 million in 2019, 40% growth. The drivers of that growth included our increase in foundry revenues, as well as the launch of our biosecurity offering. Again, foundry revenues represent what we get paid from customers for usage on those foundry programs. This is the most predictable component of our revenue, and we typically earn foundry revenue from a particular program over the course of 2 to 3 years. We increased the total number of active programs, generating revenue from 36 in 2019 to 49 in 2020, and that is despite the impact from COVID. This includes 18 new programs in 2020, and in total, we worked with 22 active customers. Our loss from operations in 2020 increased to $137 million. That's driven mostly because of our higher R&D expenses. But those higher R&D expenses supported the growth in foundry operations, as well as enhancements in foundry and the code-based assets, and of course, the development of this biosecurity offering. We ended 2020 with about $380 million cash in hand.
And so then let's talk a little bit about how we thought about, internally building up the projections for the business, both for 2021, of course, but then the longer term projections. How do you think about it? What gives you confidence in those numbers, and what should we be looking for?
Yeah, so if you look at our projections in 2021, we're expecting $150 million of total revenue, and that comprises about $100 million of foundry revenue and $50 million of biosecurity revenue. And we based the 2021 projections on 2 areas where we had high confidence, which was the firstly number of programs that were already in backlog, and therefore we have to just execute against those. But the budgets have been established and the work had already been signed up with the client. And then secondly, the conversion in the near term of a portion of our pipeline, which was most probable. And so that's really what 2021 is based on. We, just because of the nature of our business, we have pretty good visibility into the next 18 months of revenue at any given point in time, and that's just because of the programs that have been signed, plus there's a relatively long sales cycle in our programs, and so we sort of know what's realistic in the next 18 months. Now, when you go outside of 18 months in the longer term, you can see that by 2025, we're expecting to be bringing on at that point in time about 500 new programs on an annual basis onto the platform. Seems like a big number, when you look at what we're doing today, and it is a large increase. However, when you triangulate it against the total number of R&D projects that are being done today that could be done on the Gingko platform, it's really a very small market share. When you then kind of layer onto that the fact that Gingko is participating across all industry verticals, it's not just biopharma R&D projects that we're trying to bring onto the platform, the agriculture, the food tech, et cetera, just the vast kind of addressable market. We, again, get confidence in that 500 number. And then finally, again, just as a reminder, with each new program that comes on the platform, we improve our cost structure because of the foundry scale economic. That's an improvement we expect to be passing along to our customers in terms of some of those cost savings. And secondly, the code base gets more valuable. And so we think when you look at the whole picture together, we think that the 500 program count by 2025 is very achievable. And then just to give you kind of a footnote before we wrap up on financials, really just 2 points. The first is that the projections, a reminder, the projections I just discussed do not include any downstream value share revenue, income, or cash flows. And then the second footnote is around our biosecurity revenue. You'll see that we are not projecting out our biosecurity revenue beyond 2021. The 2021 projection of 50 million is based really on just the bookings that we have to date. And because of the significant uncertainty in how that market is going to develop, we just felt it best not to try to predict it. However, we do believe there is a long-term business in biosecurity. We believe we're well positioned to be a leader in that business. And as soon as we have more sort of definition on how that market is evolving, we would anticipate providing projections on how that will trend as well.
Well, thanks again, Mark, for joining me here and helping answer some of the questions that we get a lot from investors. We're going to flip over now to doing the Q&A. So if you haven't already, feel free to submit any questions via the Open Exchange platform or via Twitter at Gingko. I'm assembling those, and we're going to turn over in just a moment to the executive team that you've met over the past few hours to answer as many of those questions as possible. Thanks so much again for joining us, and we look forward to hosting you in person, hopefully again soon.
Well, that was pretty impressive. Hi, I'm Harry Sloan from Soaring Eagle, and thank you for joining us the last couple hours. And you've had a chance to learn about Gingko's technology platform and its very disruptive model. We at Soaring Eagle were attracted to Gingko because we see it as a true category of one company. And that's a company that's not only the leader in its field, but is actually the creator of the field itself, which is synthetic biology. We partnered on this deal with Dr. Ari Beldergren. He's a leader in the field of cell and gene therapy, and we believe that our team at Soaring Eagle is uniquely positioned to lead this investment into Gingko. Over the last few months, we've been so impressed with the sense of mission shared not only by the 5 founders, but all the employees we've met at Gingko. You've now had an opportunity to meet this team and learn more about the company they've built and will continue to build. So we're excited to significantly capitalize this company for growth, building on the truly unique platform of the foundry, the code base, and again, this incredibly talented team. We're confident about the value we believe Gingko will create, not only for the investors, but also for the world, driving health and sustainability at a global level. Again, I thank you all for attending.
Well, thanks for spending a few hours with us today for Gingko's first Investor Day. Gingko's a mission-driven company with a long-term vision. We've been really fortunate in the investors we've had to date who really believed in that vision, believed in the team that was pulling it together. We're excited for a new phase as we take the company public and bring along a whole new set of investors that share our vision for how biology can change the world. So thanks again.